as you and I look at the news, isn't everything crazy political? It's all political. Most of it's U.S. and some of it's abroad. There's pro-Trump this and anti-Trump that, and it's to me personally, I just kind of get tired of it. And I also try to stay away from political commentary or even leanings because I'm really looking at the market and I'm looking at the economy. And some of that does tie into politics a little bit, at least it did before November. But since that time, politics, namely the Trump administration, is affecting the market, and I believe will affect the economy. The economy moves at a much slower pace, but the market is reacting by being somewhat erratic. It's kind of gets good news and it goes up, and it gets bad news and it goes down, or at least what the market interprets as good news and bad news. It goes up and down, up and down. Very erratic pattern. And so that's showing up in what you're seeing in the stock market. So I thought this time, as I look for material, I try to find people who are kind of neutral. I mean, they probably have a bias, but they shield their bias and try to present information in an unbiased way. So I tend to like that. I also like people from this side or that side. So what I'm doing this time is to show one analyst, I guess you'd say, quasi-economist, who is saying and supporting his position that he believes that he's taking a bullish position on the market, that this is a time to be invested. The other is taking a bearish position. So I'll show you both of those, and they both support their positions. And I like both of them. So my name is Ben Reppond. Welcome to my YouTube broadcast. Today is February 25th, 2025. I'm going to begin with a piece. I'm going to play a piece where Morgan Brennan from CNBC is interviewing Tom Lee from Fundstrat. I like Tom Lee. I've kind of warmed up to him. As I've listened to him over the last, I'm going to say, couple of years, I watch his predictions, and he's willing to go out on a limb and say, this is what I think. And then I observe, okay, did those come true or not? Because they pin him down, and he's willing to take a position. And most of the time, and this is anecdotal, I don't have specific data on it, but most of the time his positions have turned out to be correct, the direction of the market or things that are going on. So that's why I like him. So he takes a position here that he believes that the market is going up, and he and his firm are taking a bullish position on it. This is the time to be invested, even though it's gone through this up and down uncertainty type of market. They did an internal poll with their clients and found that based on I guess one of the questions they asked was their political affiliation. And they found that, and this was regarding inflation. They observed that in the data, the way the people responded, those who call themselves Democrats said that they believe that inflation was going to be I think the coming year, going to be in the range of 2 to 5%. When people were answered the question that they had identified as a Republican, they said they believed inflation was going to be from 0 to 4%. That's a big difference. And so, but his point was that be careful that who a person is, their worldview, their political view, their leanings influences this, and that the data, he uses the word corrupted, that the data is corrupted based on party affiliation. I've never thought that before, but I guess that is true. He is a contrarian in this time. Now, there's times where I've seen him, like last year, he was not a contrarian. He was kind of a trend-following guy, but now he's taking a contrarian view, and that the market is down, therefore it is likely to go up. And in terms, we've heard this in the past few years, buy the dip. Matter of fact, maybe the last 10 or 15 years, buy the dip. If the market goes down, buy it because it's going to go on back up. And that's a position he's taking now. So take a listen to this from Morgan Brennan and Tom Lee.
Stocks selling off today as investors grow more concerned about a slowing economy. The Dow and S&P 500 turning their worst session of the year so far. And joining us now is Tom Lee from Fundstrat Global Advisors. He's also a CNBC contributor. And Tom, it is great to have you on a day like today where the major averages are not only lower on the day, they're lower on the week. And the Dow, the S&P, and the NASDAQ are now also lower on for the month of February so far. We teased it ahead of this conversation, the fact that you're seeing a contrarian bullish signal here. What is it?
Well, it's a couple things, but I'd say what really stands out to us is that the market has eluded extended periods of weakness because investors are bearish at the highs at a time when there's record cash on the sidelines. So to us, this is a market that is very skeptical of these new highs. That bearishness and concerns about tariffs means there's a wall of worry. So I think this is actually a very positive setup for stocks.
So you're not concerned about some of the data we've gotten? I mean, that University of Michigan consumer sentiment reading this morning in particular seems to have spooked investors, given the fact that it cited broad declines across age, income, wealth groups. You also said that big spike in year-ahead inflation expectations. That was unchanged, but the 5-year expectations moved higher too. At what point does that start to manifest into something more meaningful in terms of a slowdown here in growth?
Well, these inflation expectation surveys matter to the Fed because they are concerned about whether or not consumers are actually raising their inflation expectations, and that would in fact be bad. But we have to keep in mind the UMich surveys do seem to be polluted by political affiliation. When you break down respondents by Democratic responses, they've gone from seeing inflation under 2% before the election to over 5% today. Republican respondents have gone from 4% to basically zero. In fact, if you look at the distribution of responses for those Democratic respondents, almost 7% think inflation is currently at 25%. So I think that there is a lot of pollution in that data, and I think it's probably pretty typical what happens when there is a change in administration, but I hope the Fed is aware of that political dynamic.
So, Tom, if I recall, in Q4 last year, you were warning about market turbulence, and we've been right now at around S&P 6,000. We're at the level where we were a month ago, a month before that, in late November. Should we also expect turbulence at these levels at this point, given that the macro narrative and the political landscape is still unclear?
It certainly seems like it. I mean, I think investors can cite a lot of things top of mind why short term they're expecting the turbulence. You know, we're coming off 2 back-to-back 20% years. We know there's significant uncertainty about tariffs. In our latest client survey, 63% of our clients, and that's over almost 2,000 respondents, said tariffs or deportations is the biggest risk. That's up from 54% last month. But these are not things that have necessarily long-term negative effects. In fact, things like the number of Fed cuts is actually back towards 2. And I think there's a possibility the Fed may actually make cuts sooner. I think one thing the market is being complacent on is thinking the Fed's on hold. But if this turbulence causes hiring to slow, I actually think the Fed could actually be making cuts a lot sooner, which would be positive for stocks.
Next is an interview that Julia LaRoche does with Edward Dowd. Edward Dowd is a market analyst, has a background in equities and fixed income, and it looks at things from an economic perspective as well as a market perspective. And she's kind of questioning him on what his view is, the market view going forward. He believes, and he says this, if you listen for these words, that we're probably headed into a worldwide recession. And then he explains why. He says during 2024, and it could have been 2023 and 2024, that the Biden administration was pushing money into the economy, spending lots and lots of money stimulating the economy. Well, some portion of the economy responded positively to that, but he points out that some other portions are already in a recession. And then Trump comes in and he takes the opposite approach to undo that spending, maybe reverse it or stop it or something. So in other words, a stimulus goes in and then there is a stop to the stimulus. So, and because of that, he attributes his position to that. And he says in 2024, they were expecting that the market was going to go into some kind of a recession, or not the market, but the economy was going into some kind of recession. And he said that didn't happen. And the reason it didn't happen was because of the stimulus that came into the market. So he believes that the conservative approach of stopping the spending is sending the market into confusion and uncertainty. And you could say it also is projected to send the market into more confusion and uncertainty. The market hates uncertainty. So right now, people don't know what to think. I mean, they're like, okay, we're going to acquire this country or that country, or we're going to apply tariffs. And you go, well, the tariffs have been around for a long time. They worked effectively in the past, but they haven't been used very much in recent times. So what does that mean for the market? A lot of people don't know. Is this positive or negative, or positive for the long run, but negative for the short run? Again, the market is responding with a jagged up and down, up and down. It gets this information and it goes up, another information and it goes down. And so there definitely has been some negative, but more than anything, you could call it uncertainty and maybe a sideways up and down market. So anyway, take a listen to this. You could listen to I'll put the link to the entire interview in there if you want to listen to it. I think he does a good job of explaining his position, and I think he does as much as he can to take a neutral position. How I interpret people's political leanings is, can I figure out which side they're on? And with Edward Dowd and Tom Lee, to be honest with you, I've listened to them a lot. I don't know which political party they're mostly affiliated with. So, but again, he does a good job. And I'm going to make one other comment here. And the reason I play Mohammed El-Arian a lot is that he does the same thing. He presents things with, whatever bias he's got, I think he sets it aside to try to give a more neutral view. So anyway, to listen to this, Julia LaRoche interviewing Edward Dowd.
I do want to start where we always start, and that is more with that big picture, more of that macro view, where we are today, the framework that you are looking at the world from. And as you know, Ed, you can take all the time you need to set the table when it comes to that big picture macro view.
Yeah, sure. So, before I came on your show, we at Finance Technologies have a very rigorous early cycle indicators that predict recessions and where we are in the economy and recoveries and all sorts of good things. And we like other economists, our economic cycle indicator, early cycle indicators indicated a recession at the end of 23, beginning of 24. That never occurred. Our cycle indicator started to bounce. We thought it was going to be a false positive, but it bounced all the way up to a zero, which for us is not economic expansion. So we came from very low levels to almost expansion, but then we started rolling over again in 2024. And the reason, we asked ourselves, why were we wrong? And why have the laws of fundamental economics changed? Well, the answer is they didn't change. We saw something so unprecedented in the history of the United States, combination of fiscal dominance, the deficit spending levels that were crisis level. You got to remember the great financial crisis, we had 9-10% deficit levels to GDP. We were doing 8% in 23 and 24. And so we've kind of reverse engineered what happened, and it was unprecedented government spending, hiring, and the facilitation of 10 to 15 million illegals into the country. And that's been the economic variable and the elephant in the room. That's why a lot of economists got things wrong. It didn't grow the economy; it just kind of stabilized it. And there's been economic confusion. PMI and capacity utilizations indicate economic weakness. There's a disparity in the household survey versus the establishment survey, and so what we figured out was this phenomenon really juiced the economy, and everything Trump's going to do is going to reverse that out. It was unsustainable to begin with because you can't have $2 trillion deficits. You can't import 10 to 15 million people in a very short order of time without a regime change, which we got. The middle class was already experiencing what I would call a recession. So in 1980, Ronald Reagan got elected because real wages were minus 2%. Same thing happened for Bill Clinton in 92, and Trump had minus 2% real wage growth. So it was the economy, basically. So the only people that have been benefiting from the economy are the top 0.1%, those who own most of the financial assets in the country, and the very low end, the very poor, and the illegal immigrants who are coming in, getting accommodations and goodies from the government and the NGOs. And now we're learning there are a lot of revelations going on in the news today about how this worked. The government, to get things done that they didn't want people to see, they would dole out money to NGOs, as NGOs that would then take their cut and then facilitate this illegal immigration. So the economy was really held up and limped into the finish line in 24 by all this unprecedented spending. And everything that is going to happen is going to reverse out. The housing market is a big problem, we think.
Okay, thank you for watching. If you like this, hit the subscribe button below. And if you have questions or comments, leave them in the comment section below. Thank you.